presentation.
I'll stop sharing. There you go.
Okay. So just some general housekeeping rules, muting when the speakers are going through their presentation, and also about us providing quality, compliant and cost-effective financial advice. Focus for us, we got our license 5 years ago, not to be a lone wolf, but to actually be able to advise our clients and be really aligned with their interest in a truer sense. So for us, it was just a natural next step with everything that occurred in our industry back in 2018. And we do provide a hybrid model. So Michelle, you would gladly know that a large part of our clients now interact by Zoom, but there are those that appreciate seeing us face to face. And I think that's my preferred approach with everyone, at least meeting them to understand what their situation is before we actually do any financial planning. As I mentioned to you before, it's all about clients' needs first. What we want to do is be involved in their lives, but also interacting with all their advisors. So be it their solicitor, be it their accountant, and various other financial advisors. And more importantly, if we can, be involved with their family unit, those that are important to them, because there's no financial plan if we don't understand their situation. The other aspect to that is we don't have any commissions. We're a commission-free business, so we really focus on charging for the work that we do, not for work that we don't do. And I say lean and mean and green. We try to avoid the duplications, the multiple signatures that create all sorts of headaches for clients. So there are various legacies that we work very closely with our compliance officer to remove, to avoid duplication. Without duplication in the past, that become costs to our clients, and so we want to make it as hassle-free as possible. Good. There's a good crowd today, which is excellent. So we couldn't do it without a good team. Our team involves, Hen Nguyen, who's our operations manager, been there since the beginning. So she really runs a lot of our operations, looks at our well-being, not just from a financial perspective, from a sustainability perspective. So we're there for as long as we can with our clients, but because we do believe being in clients' lives long-term is the way to go in terms of building relationships. I've replaced John Moore, with Ryan Moore, who's now the successor in a tax advisory business based in Bondi Junction. Without them, we wouldn't have had our license. So Ryan Moore's the new generation of more and more accountants. And the reality is they have provided us with great support with our clients. Okay, yeah.
I'm okay.
Having that engagement with our clients and their clients from a total holistic perspective. Evelyn's our compliance consultant from the beginning, so she keeps us to account, making sure that all our files meet the highest regulatory and industry standards, and we're not deviating from that.
I might need to hire her.
You may do. She's one of the best in terms of keeping it very, very clear in terms of what's required. She's based in Melbourne. It was very hard to find as a license someone that would work with you from a compliance but a commercial perspective, making sure that it's viable. And our approach, as I was saying to you, Michelle, earlier on, is we look at advice from a holistic perspective. And I think it's not just what do you have to invest and that's it. It's and I think it has to do also with the training I've had from a very good bank, despite everything that came apart back in the 80s and 90s, is the whole approach to advice is wealth accumulation. Everyone wants to make money, but what are the contingencies? What are the what ifs? And that falls in that wealth protection bucket, reviewing existing insurances.
So what you're saying to me
Yes.
is that you're not looking at transactional work. You're looking at ongoing client development.
Absolutely.
Yeah.
And that lends to wealth distribution as well. We find too many of our clients do not have a will, or they have one that was handwritten back in forever ago, and it's not relevant.
But from a lawyer's perspective, they're the best ones.
Yeah, so
because they're the ones that end up in litigation and cost lots of money.
and at the end of the day, what we want to do is make sure they do have a will, a valid one, and it sort of integrates in that holistic approach. And for me as an advisor in Rounded Wealth Advisory, it's just about value for the process, the journey. We'd like to not think of it as a process, and we're talking about the biggest asset for our clients. It's not so much how much they have to invest, but rather the personal, emotional
The relationship.
comfort and the relationship and the peace of mind and the clarity and clarification around their future. And also, I just love this quote. I've forever carried it through being an advisor. You can't change your world as a planner or an advisor, but it's one more step that helps create a giant leap for every family or every client or every business client that we represent. And so I've taken 10 minutes to introduce a little bit about what we're about, but it wouldn't happen without the key people around, including Claire Phillips at Australian Super, who from day one has been most helpful in terms of helping us navigate planning where we are and what we need to do. And so the speakers today are Tony Morris and Felicity Emmett from Australian Super. Super doesn't need an introduction. It's Australia's leading superannuation provider by country mile. There's no question about that. It manages, correct me if I'm wrong, something like $380 billion of Australian
Big dollars.
assets. And we're quite privileged because we got Tony and Felicity here with us to take us through their views. And we talk about macro and micro. And as economists, I've put them as strategists for what a better bucket description. Hope that's all right with you guys. And
I think Finlay, we just hit the 400 billion mark as of last week, wasn't it?
congratulations.
Yeah, I can see Felicity nodding. So
it just keeps going north and north and north, because with the Australian Super comes confidence, comes trust, comes a great level for us from a small advisory licensee holder, comes with a level of security. And we couldn't partner or align with any other brand that pretend to have those things but impliedly do not. Where we're actually really happy with the relationship we've had. So without further ado, and then next will be Salvador from Lydian Private. It's on his way in, and then Michelle Johnson as well. Over to you, Tony. You can share again, buddy.
Cool. Where are we? Thanks so much for the invitation to come and speak to you all. So I'll speak first just for 5 or 10 minutes or so, and then I'll hand over to Felicity. So we both work at the sort of the top of the fund, the asset allocation. We're both economists. We've worked together previously at one of the big domestic banks, but I focus very much on global and long-term economic and investment themes. And Felicity works on understanding what the implications are for Australia. So we'll take a sort of an economic view. I'm going to try and explain what we think Trump is doing and what that's having on the world. And then Felicity will try and make some sense of that, difficult as it may appear. So we will use several pictures to do that. And we forwarded the presentation, but obviously you have to do a bit of a disclaimer there as well. We don't have any detailed specific investment advice here, but happy to discuss it. So what I'm going to try and do first is just try and put some global context here. There's global structural change going on. I like these two pictures. One on the left is if you remember when Donald Trump's first administration, there was a huge pushback on what he was trying to do from the European Union. That's Angela Merkel in the middle there. But now there's been a huge amount of payback with him coming in. I'll try and explain what he's trying to do with tariffs, but there's tax cuts. There's worried about US exceptionalism. He's a very mercurial, just flooding the zone all the time. So how do we make sense of that? Is that all of a risk, or there are some opportunities there? Clearly, the world is changing with that. We think that the world is fragmenting. There's increased US-China competition. So that picture on the right-hand side, I think, is sort of where it's really at. So all this news you see on tariffs with Europe, Canada, Mexico, the really big game is the relationship between China and the US. Of course, Australia sits between two of these. China is our largest trading partner, but something that's not sort of reported as much is that the US is by far the largest investor in Australia. Think of all of the oil and gas investments, for example. So how the world works is really important for Australia. In terms of the themes and what we invest in, because we invest for the long term, with that amount of money that we're now managing, and it's only going to continue to grow over time, we've got to take a sort of a long-term view. So we believe very much in technology being very transformative. So we make a whole lot of real investments, not just in the companies, but in the real assets such as data centers, transmission lines, and power, for example. And those two things are very much combined. So whilst you might think all of this news on Trump and attacking the Fed, for example, is really bad news, one of the reasons not only why the stock market in the US has hit record highs, but the economy is doing well, is just the amount of money that's being invested in that sector in the US and the leadership of those companies. We also do a lot of work on population, fiscal pressures. They're really important. But I think a key message here is that there's just more volatility in markets at the moment. We think that interest rates overall will settle a little bit higher, even though we're in a cutting cycle. So again, trying to be relatively quick. What I think is the really big story here. I think a lot of what you can see Trump doing is actually a reaction to the rise of China, which has been so beneficial from Australia. But with that rise of China, you've had an increasing US trade deficit on the left-hand side. That's almost $1.4 trillion now. And on the right-hand side, you can see China's trade balance is above 1.2 trillion. It's not necessarily just directly with each other, but I think that's one way to think about what Trump is trying to do. He's trying to level this back out, and he's doing it through tariffs, which are a tax on everyone. You'd think that it would result in higher inflation and lower economic growth, and we think that is going to happen, but it's not very much as straightforward. But I think this picture here just sort of shows you what Trump is trying to do. So we now in quite advanced on the whole tariff. We think that effective tariffs will settle something between 15 to 18%. I'm sure Felicity put me right from the economics team what they're thinking there. We haven't seen this level of tariff since the 1930s or before that 1910. So this is a really unusual. This is undoing of global free trade, and it's having a huge. It's causing a lot of uncertainty across markets. This bottom left-hand chart here shows you what these measures of so-called policy uncertainty in terms of US policy. The uncertainty has been higher than in COVID or the GFC, if you can believe that. And a lot of that is driven by trade policy uncertainty. You just don't know what he's going to hit next in terms of like India being hit with 50%, what happens with China. Anyway, what are he trying to do? He's trying to raise money. And already tariffs, I think I've seen some estimates, this raised about $30 billion in revenue for the Treasury. He's trying to be very transactional and exert control over where those trade flows goes. He's trying to get reshoring for national security. That is, companies such as Apple being I suppose, incentivized to get back to the US to invest there. And he's trying to create jobs in the manufacturing sector. So the second point there, Trump is trying to put a stop to where he thinks the world is taking advantage of the US, and he's seeking concessions rather than he's looking to rebuild manufacturing big time. Now, he has had some success. The Europeans have got the message. I think they've understood. They've maybe had very preferential treatments, and they're going to be spending a lot more money on their own infrastructure, their own technology and defense. Here, I've got a lot of trade deals now. the Germans have removed this constraint on their debt. They're investing 600 billion euros in their own defense and infrastructure. And also, he's been reshaping the Middle East. Very contentious, I know, but the cost is pretty high. The goodwill of allies such as ourselves, US leadership of the global order, trade inefficiencies. And a lot of people are questioning, do you want to invest in the US long term? We think yes, because of the companies there, but there's certainly been a cost with this. And the cost comes from higher inflation. On the left-hand side is a market measure of expected inflation that's just risen over the next 2 years in terms of expectations since Trump has come in, and this gap between short and long run inflation is opening up. Remember, the US Federal Reserve is supposed to try and keep inflation close to 2%, but the market thinks it's going to get closer to 3%, maybe a little bit higher. And also more uncertainty, and the end of this free trade has seen things such as new industrial orders in the US, China fall, but in Germany, they're actually rising. They're still not expanding. So that's the net outcome, higher inflation, slower growth. That's not such a good outcome for investors longer term. But I thought I'd include this one. I've almost come to my section because I'm mindful of time, to show you what a global fund manager service. This is not a Australian Super's view. This is a survey of all fund managers around the world. They're much more bearish on the world than the current levels of the S&P 500 would suggest. They're still sort of negative in terms of what they're expecting in terms of a stronger global economy, but it is recovering. And this right-hand side one is kind of interesting. That where do you see the biggest sort of risk to the outlook? Trade wars remains high. Inflation prevents Fed rate cuts, although the Fed now looks likely that it'll cut rates next month. Trump is going after the Federal Reserve. That's not good for central bank independence, but it will, I suppose, lower rates will help the growth outlook for next year. I thought that was quite interesting, and a disorderly rise in bond yields. As you see short-term interest rates fall and governments spend more and more on defense, longer-term interest rates will rise. So we think that will be continuing, and we're investing along that. And finally, before I hand over to Felicity, these are some of the factors that we think about long-term. So demographics, global population is peaking and will fall quite sharply from here. That'll be another headwind to growth. Australia, by the way, is one of the best countries in the world for demographics. That's because we still have a relatively high level of migration. Decarbonisation is ongoing, but not quickly enough to stop the world heating up. So we look at a range of investments around that. Digital, we're big investors in. Decoupling, I've touched on already. That's trade and fragmentation. Also, you'll see disgruntlement, trust in government and institutions is falling. And on the other side of this, debt and deleveraging. That's a very challenging outlook. But I think we try and position the portfolio at Australian Super to be exposed to the opportunities there in the tech side, but reduce our exposures to area that might be a little bit more challenging. So with that as a backdrop, I'll hand over to Felicity, and I'll drive these as well. But what could possibly go wrong, Felicity? Stock markets at record high.
That's right. That's right. Thanks, Tony. Yes, I love this cover of The Economist. It's from a while back now, but yes, what could possibly go wrong? So I will just talk a little bit more about Australia and how some of those themes that Tony's talked about are flowing through, and also what the current situation is in Australia in terms of the economy. So many of those global thematics are important for Australia as well, and they're driving the longer term outlook or impacting it, and they're also driving, as Tony said, more macroeconomic volatility and also higher inflation. When you look at something like one of those D's, decarbonisation, or the climate change theme, we're seeing a clear impact in Australia. We've had temperatures here averaging more than 1.5 degrees above pre-industrial levels for some time. We're having more frequent and intense weather events. When we look at Cyclone Alfred, in southeast Queensland and northeast New South Wales earlier this year. It took around a quarter of a point of growth for the quarter, and also it didn't have as much impact on inflation as some other cyclones, but these are the sorts of things that we're seeing that can impact growth, productivity, and inflation in the short term. But these global developments and themes are really likely to remain centre stage when we're looking at the outlook for Australia. So, Tony, if you could switch to the next slide, please. So Tony talked about decoupling, global decoupling, and tariffs in particular. These charts here show on the left-hand side Australia's balance of trade with the US. So we're one of the very few countries that run a trade deficit with the US. So we buy more from the US than we sell to them, and that's part of the reason why we ended up with that base tariff of 10%. But China is by far and away our largest export market, taking about a third of our exports. But as Tony pointed out, the US is the biggest investor, and also this is the other area of conflict for Australia is the fact that China is our largest export market by, as you can see in that chart, a country mile, but the US is our closest strategic partner. So it does put Australia in quite a difficult position, and it's really hard to know given the capriciousness of the US administration how that could pan out in the longer term. The tariffs, though, have really a small impact on Australia in terms of the direct impact. That they're 10%. We sell less than 5% of our exports to the US, and so it's really that direct impact is quite small. We were worried initially that we could have seen a larger impact indirectly from China, but given the level of tariffs from Liberation Day have come down, they're still very high, but the Chinese government has delivered some stimulus and growth is holding up quite well in China. So we're less worried about that. The third channel where these things can have an effect is through uncertainty and confidence. And Tony showed a chart there of the rise in uncertainty, and we're definitely seeing that in Australia as well. But what we haven't really seen is we haven't seen that high level of uncertainty flow through to lower confidence. So business confidence looks okay. Consumer confidence is actually recovering quite well. So in terms of the short-term impact, it looks to be quite limited, though. We have to remember, though, Australia is a small, open economy, so higher global tariffs will lower world growth, and so in the longer term, this will be a headwind for Australia. Next chart, thank you. And so one of the other longer term challenges that we've heard a lot about recently is poor productivity growth. Now, these two charts I've got here a little bit replicated. So the one on the left-hand side, which is the one that we often see or the one that we often hear spoken about, is Australian productivity against US productivity. Now, this is, I've re-indexed it, so we're just looking at it compared to as a base of 2019. So essentially the pandemic and post-pandemic period. And you can see there that Australia's productivity has been flat to lower, and the US is significantly higher. There's a great big gap there. But if you look on the right-hand chart, you can see that actually Australia looks very much like all the other countries. It's the US that looks very different. So there are strong global themes that are driving this weakness in productivity. And you can see some of these things include lower rates of investment, particularly post the global financial crisis, high or lower levels of competition and business dynamism, slower diffusion of technology through the economy, and And also, this is true globally, but particularly true in Australia, a higher regulatory burden. There have been a few temporary factors that might have held down productivity in Australia in the pandemic and post-pandemic period, but even if we take those into account, productivity is still lower than it has been. And we saw a couple of weeks ago the RWA revised down its longer term estimates of productivity from 1% to 0.7%, which is more in line with what we are thinking, but there is a lot of uncertainty around that. The government's economic roundtable is encouraging in this regard, but it is very difficult for governments to deliver reforms. We've seen that over the past couple of decades. There's been a number of productivity reports. Most of them end up in the bottom drawer of the current government. And so we have to be sort of cautious about the government's ability to deliver much on this, but perhaps cautiously optimistic. So on the next slide, there are reasons in the near term to be relatively optimistic about the growth outlook, where what we've seen is on the chart on the left-hand side, you can see there a big lift in growth in household income, particularly focus on that red line, which is real household income. So that grey bar in between the nominal and the real is inflation. And that's really what's been dragging on household incomes or household income growth over or through that pandemic period. And now that inflation is really back close to the RBA's target band, that's less of a drag on real household incomes. And we're seeing, as a result of that, consumer spending start to pick up. And that will mean what we'll see is stronger growth overall and a handover of within growth of the driver from being public demand, which you can see on the right-hand side, those blue bars are public demand. They've been very big recently, where private demand has been very low. But we are starting to see a recovery, and we will get data for the second quarter next week. And we should see, more stronger growth again in private demand that will drive the recovery. So we think GDP growth should step up to about 2% by the end of this year, which is much better than the 1.3 or so that we recorded last year. So that is an encouraging story. On the next slide, thank you. This chart here shows on the left-hand side, shows Australia, the inflation deviation from targets. So these central banks all have their targets for inflation. Australia has ours, and this chart shows how far away current inflation is from the target. So you can see there that actually, for all the criticism that the RBA has received, they've actually done a pretty good job. And you might remember Phil Lowe, the previous Reserve Bank governor, and Michelle Bullock, the current one, have often talked about this narrow path where they return inflation to the target, but they maintain the gains in the labour market. And that is essentially what they have done. You could see on that right-hand chart there, we've seen a little bit of a rise in unemployment. It's currently at 4.2%, up from the low of 3.5 or so, but still well below where it was prior to the pandemic. So that really has been, at the moment is really quite a success story for Australia. And I think that we're unlikely to see at this stage, I'm certainly not expecting a big rise in the unemployment rate. When we look at some of the leading indicators, what businesses are saying they're doing with hiring, things like job ads and job vacancies, they all suggest that probably the unemployment rate won't rise much more from here on. And so I think the next one is the last slide. Thanks, Tony. And this easing in inflation has enabled the RBA to cut rates, and they are likely to cut further. The minutes from their latest meeting were released yesterday, and they said that it basically said there is more monetary policy easing to come over the coming months. So we expect there to be 2 more rate cuts in November and February. That's quite similar to what the market is pricing. You can see there that chart shows the market pricing for the RBA cash rate, and that will help to support asset prices. We're already seeing a recovery, quite a good recovery in house prices and other asset prices. Looking ahead, the RBA will change rates as it sees fit around the inflation and labour market story. But these are all short-term sort of influences. It's these longer-term influences that Tony talked about and the government is trying to address that really will have the bigger impact on asset prices over, investment horizons. And I'm happy to leave it there and take any questions that anyone has.
That's great, Felicity and Tony. Great session. Definitely, the 6Ds appeal to me. I'll kick off with a question. I heard the concept of VUCA. I don't know if you've heard that before, but the new world order is all about volatility, uncertainty. What is it? I should remember it off by heart. I heard it, complexity and ambiguity. So it's not a usual sort of holding pattern with clients' portfolios. Where should they invest? We talk about asset allocation. So my question is, with the 6Ds and the thematic view you're holding, are there any changes in your asset classes that we've got a good cross-section of pre and post-retirees that have logged on, business owners? What are your thoughts, I think, from a macro and micro perspective that you guys are sort of approaching future?
Yes, I might sort of kick off and others can chime in as well. So actually, I do have a chart which might be of interest here. I think this is the biggest challenge for us. It's just how much we felt in recent years that the Mag 7, there's now been changed to the AI 8. Those are these really big technology companies. They've completely driven stock market performance over recent years. In fact, on the right-hand slide here, it shows you the proportion of the total market coming from the top 10%. This is the US market by market value, and we're in record territory. So we're a little bit cautious with everything that we've highlighted here on the global view, that valuations, particularly in this area, look a little bit overstretched. So we've been looking to scale back a little bit of our exposure here. Nothing to do with US exceptionalism. It's just we think we're a little bit more concerned about that mix between inflation and growth. We're looking to hedge a little bit more on this impact of rising inflation. So one of the other areas on asset allocation we've been looking to do is increase our investment in unlisted, that's property infrastructure. They have a much better correlation with inflation over time. So there's a little bit there of a hedge. And in terms of because we've got such large funds under management, we have to make more and more of our investments overseas just because of some of the limits domestically as well. We still feel comfortable having an active approach to international shares. We've put a lot of resources into London to be able to do that, to diversify some of our investments. And the final point on asset allocation, we have taken some steps to hedge our exposure to the US dollar in a kind of a basket approach, thinking that the pressure that Trump's putting on the Fed now, the expectation of the market to cut interest rates, but also a bit worried about how investors view some of the constitutional changes in the US and the role of the US dollar, that maybe this is a good time to hedge it. So those are the things that we've been looking to do. On the 6Ds, still very much believe in technology, worried about debt, the energy transition. That's still some opportunities there, but been quite cautious in where we invest there, just because we're out to make sure that we put the financial interests of our members first. So we're going to be very judicious there where we invest. So I might leave it there, Claire or Felicity, if you had anything else to comment or add.
That's terrific. AIA, that's the first time I've heard it. You hear new things every time, and it's very interesting. And for those with a sort of a higher weighting towards Australian equities, saying have the Magnificent Seven now been overvalued, but with AI now being a little bit of an accelerator, do you take the view that there's still more growth in these Magnificent Seven in a global sense, or is it worthwhile for diversification purposes looking at other asset classes other than just shares? Because you guys manage infrastructure, which I know is the sort of unsexy asset class, for what a better word, but it's consistent. It's a great income stream. What I'm finding with our retirees is they can't live off potential capital growth, but they can live off income. What are your thoughts about de-risking portfolios away from equities? Because it's something we're conscious about with our clients' retirement funds.
Yeah, I suppose the comment I made there is a matter of degree. So we definitely feel in terms of valuation that some of these tech stocks look a little bit stretched, as you can see on these slides, but we still believe that they're going to be massive drivers of revenue going forward. So it's just a matter of how you weight that. I would agree with you. This allocation into these real assets is something that we'd be looking to do a little bit more over time in terms of infrastructure, property, and unlisted, because the size that we have, we're able to access, I suppose, a range of investments that retail investors might not get so much access to. But overall, we are overweight to growth assets, which means stock markets. Thinking of growth next year, as Felicity was mentioning, in Australia, we've had a bit of a slowdown, but like lower interest rates, for example, and ongoing fiscal support, even with some consolidation, means that growth into next year will look reasonably good. But this is going to be, I think we're just a little bit cautious between now and the end of the year until it's really clear where these tariffs will settle.
That's fair enough. That's great, Tony. Any questions, audience? Feel free to ask.
I've got a sort of probably a simplistic question, Finlay. It's being a layman, is there a good time or a bad time to move a relatively large sum of money across to Australian super? I'm thinking of, should one wait till the ASX is low and then move the money across then, or is that irrelevant? And also, the follow-up is, once the money has been transferred, what's the time delay, or if any, between that money being transferred to Australian super and it being invested in something?
Claire, did you have any comments on it?
Yep.
Oh, yeah, Finlay.
That's okay, Tony. You've answered a few questions, probably directed as his advisor, as Don's advisor. We've made one or two contributions already. It's easy peasy. You can do a BPay transfer. You can do an EFT at the bank level that clears within 3 working days, and it's ready to be invested based on your current mix or proposed mix. It's quite easy, as you know, of course, subject to the concessional contribution limits or non-concessional limits that's available to you per year. And as you know, the members access, the members portal is very, very streamlined. It's quite straightforward. You log in, you can see exactly whether it's invested in the DIY selection, so your pre-mix selection. I hope that answers your question. That happens pretty quickly. I know.
My main question is really, is there a good time to move cash across to Australian super? And I presume once it's over there, it'll be used to buy whatever, to invest somewhere. Would I be better off waiting till ASX is really low to move it across? Or, is there a good time to move it across? I do it any old time? Does it affect anything?
Yeah, great question. I mean, there's one thing I learned over 20 years as a planner, there's no better time than the present. You can go forever waiting for the markets to go down. I mean, we've been waiting for the markets to crash for about 12 months and it hasn't happened. And all that has happened is that people have missed the upside. And with a dollar cost averaging, in your situation, Don, as you know, you're in a retirement mode. Adding to your super means two things. You're getting the upside of the returns based on the current selection of options that you have, but also secondary. The whole idea of an account-based income stream is the definition of it in retirement is designed to run out. So by putting in more, that means you can potentially do more fishing, more trips with your friends, and then still have something left for the children at the end of it. That's what we've done the planning for you. And so the timing for us is potentially irrelevant because at the end of the day now the funds were sitting in an interest-bearing account per se. The rates are going down. As we've just learned, there's potentially 2 more cuts coming for a good Christmas barbecue for most. An exciting one, couple of toasts. But that said, probably from a medium to long-term perspective, in my view, my counsel to you and others is it's better to put it into super because you're getting the tax-free benefits anyway along the way, as opposed to the earnings getting taxed outside of super. So the cost of waiting for the markets to go down could be greater than you think, particularly if you look at the last 12 months. It hasn't gone down, and you could get caught out timing. Sorry, that's an extended answer. Hopefully we could answer that a little bit more for you in our next catch up over a coffee. And was it banana bread? Is it? Yeah, that's your favourite.
Oh, well, yeah, or raisin toast you seem to like for some reason.
Yeah, no, it's always a good catch up. But thanks, Tony and Felicity. Hope you can hang around for another 20 minutes. So great segue about interest rates going down, creating affordability, creating better level of income for our existing sort of wealth accumulators, but also most of our clients and most Australians getting a little bit of reprieve. But there are some great lending options that are available in the marketplace. And one of the things that we're doing increasingly with our clients, particularly with good combined super balance, whether it's a partner or a family situation, is to look at self-managed super funds as a proposition for them in terms of building current and future wealth, but also looking at the affinity with bricks and mortars. So most people go, I want to set up a self-manage, I want to buy a property. It sounds simple, but it's very important to understand how it works. And I've brought Sal along. We've been friends forever, and I mean forever. And he's now a partner of Lydian Private to talk to you about some of the great stuff they do. They do some wonderful stuff, and lending and creating a solution for clients is no longer just going to a bank and putting in an application. It's a lot more involved, would you say?
100%.
Yeah.
A lot more structuring and figuring out how to.
I'll pop your presentation. You want
Yeah,
to
please,
pop
if you
that
can.
up?
Yeah.
Terrific.
Well, I guess while you're doing that, I mean, to introduce myself, my name is Salvador. I run a mortgage advice business named Lydian Private. It's catered to high net worth clients and their advice partners. So we aim to do 3 things. We aim to help our clients grow, protect, and pass down wealth. Those are the 3 pillars of what we do. And we're quite lucky that we actually see what this segment of the market is thinking and what they're doing, because there is merit of seeing this, because they're usually the first to act or the first to see what's coming next behind the horizon. Not because they're necessarily smarter than everyone, because they've quite experienced and also they're pretty well advised. So we help a wide range of clients, as you see on the screen. They range from medical professionals, senior executives of listed businesses, sophisticated investors, all the way to family office clients. We help them with a wide range of lending options, such as access to private banking, high net worth policies, which I'll touch on later on in the presentation, resi commercial, all the way down to private funding. we've helped many clients structure finance with the assistance of their trusted advisor, whether that's an accountant, their wealth advisor, or anyone in between to help be part of that long-term growth. And ultimately, what we want to do is just be part of that overall advice team. So what I'll do, if you don't mind reaching out. Yeah. So what I'll do first, I think it's quite important, is to touch on some relevant and fairly new developments in the property market and where we think the property market will go in, especially in the next 2 to 3 years in the short term. The first major change just happened actually over the weekend, which is the change to the first home guarantee scheme, which was always in the talks to start in 2026. It wasn't quite approved. It is now approved. So anyone that wants to buy the first home, or anyone that wants to assist the kids or have kids that want to buy the first home, it's quite a major change. So the first bit of good news is, it's quite favourable, is that there is no limits to the placements of these schemes. It was previously limited at 35,000 places. Now anyone in Australia can apply. There's no income caps as well. So before the announcement, it was capped at 125,000 per individual and 200,000 for joint households. It's now anyone that, I guess, any income level can apply now, which is great. Now, the property caps have also been increased, which I'll touch on quickly. So for New South Wales, it was 900. It's gone up about 60% to 1.5 million. Victoria up about 20% to 950. Queensland another 20% to about $1 million. WA, South Australia, Tasmania, and ACT have also increased their price caps, which is good news. But with that, there is some bad news. Now, the bad news is, it might not be obvious, but I think property is about to get a whole lot more expensive. That's if people are slow to move. There'll be a lot of headwinds in the property market just based on this. So, when people are trying to get to a high price point, there's more demand. There's still limited supply. So supply and demand dynamics, it's pretty clear that property market's going to go one way, which is up, unfortunately. Will it ever stop? Who knows? Will the government be brave enough to do some tax reforms in the property market? Again, who knows? And I think that's the only way to sort of stagnate this property growth. I don't think it'll ever go down, but it does need to sort of take a breather at some point. It just doesn't look like it's going to happen anytime soon. Along with that, I don't know if anyone, especially people in New South Wales and Sydney, they would recognise that top picture, which is Woollahra Station. That's the ghost station of Woollahra. It was built in 1976, I believe, which is now almost 50 years ago. It was never finished. The government over the weekend has announced the reconstruction or the redevelopment of that station to be finalised. There is a plan to enable up to 10,000 new homes around the area as well. Now, the government was very quick to do this without consultation. I think Chalmers feared the not in my backyard or the NIMBY backlash from local residents. So he pulled the trigger and it's now live. So that should increase some supply to the market in probably the next 2 to 3 years. Now, everyone would know the housing crisis. That's talked about all over the media, and the government throws it around every now and again. In late 22, the Chalmers government announced a plan to tackle the housing crisis in what they call the National Housing Accord. It was originally 1 million homes in 5 years. It's been increased to 1.2 million new, well-located homes over 5 years to 2029. We've now hit the 1-year anniversary of that, and we're well behind. So the target for that to meet the 1.2 million was 240,000 new homes. The actual commencements of that is 170,000. So we're definitely well below that. If we look at the graphs around that, annualized over the last 3 quarters, 178,000 commenced and 178,000 completed homes. If we look at the homes under construction, it's about 220,000 homes under construction as it stands for the calendar year. As I said, we need 240,000 to get to that level. So we're very behind that target, unfortunately. So again, with constrained supply, property markets are only going to go one way, which is up. So just to summarize very quickly, commencement 178, completed 178, under construction 220, we need 240. The trend is not there. Good news for everyone is the interest rates have been cut. There has been 3 cuts this year so far, February, May, and August. There's still 3 more RBA meetings till the end of the year. I don't think there'll be one in September. There might be one in November, maybe another one in December, but it is some good news for mortgage holders, which is good. It's now 3.6%, down from 4.35%. So we'll see what happens. The other interesting thing that I don't think many people are seeing is that I think Tony mentioned it before, is that equity markets have increased significantly in the last 2 years. We've gone from record highs to record highs to record highs. It doesn't seem to end. So what that's meant is that large institutional investors and super funds have become under allocated to property. So they're slowly coming back to the sector as rates fall. If you look at the ASX 200 real estate index, which includes REITs, which are real estate investment trusts, and other development companies, that index has already increased 25% since April this year. So you can see there's a lot of inflows into that market as well. And I think that will continue to happen in the next, at least the short term, at least 6 months. The bad news is there hasn't been any new developments in any markets. There's been no new offices, no new shopping centres, no housing, as we touched on. So when there's this renewed interest or renewed demand in property with lack of supply, that adds to the property growth. So again, we think that property will go one way, which is up. We think that property will increase significantly in the next 6 months, up to maybe potentially 8% in 6 months, which is significant, but we just don't see it stopping, unfortunately. The banks have also deregulated some policies as well, which would help properties. So I think it's going to be tough for those who wait. So we are getting a lot of new inquiries for property as well. So in terms of our market, our segment is high net worth. So we do have access to a lot of policies in this space, whether that's clients with significant liquid assets, where they don't traditionally meet the servicing metrics for banks. We can structure loans where liquidity exceeds the debt to meet servicing. We can do short-term or bullet loans where there is a clear exit strategy as well. So clients with a lot of assets with asset-rich income poor, we can help in that regard as well. High loan-to-value ratios for prestige properties. We've helped a lot of clients in that space. The ability to use vesting stock for execs in listed businesses as well for income without the need to sell those stocks as well. There's capital gains involved in that, and they forego the upside. So we can actually assist in that. We've actually been able to assist with structuring non-recourse lending on cryptocurrency and shares, which has been quite an interesting segment. We've done a lot more loans in the last, say, 3 to 6 months than the last 3 years in that space, which has been quite interesting. And I guess the last thing I'll touch on is a real live example for a client that we've helped. A client that came from a private wealth advisor that we're very close to. The client was in his early 70s, has quite a large investment portfolio. He has about 6.5 million in super, another $11 million in investable assets with the advisor. Now, what he wanted to do is refinance circa 6 million or 6.5 million in investment debt with a major bank, and also increase his facility by another $2 million. And it's not to build his own wealth, but he wants to leave a legacy to his 10 grandchildren. So what he wants to do is help his grandchildren get into property and gift a certain amount when they get older. I think he wants to do it. I think it's about 500,000-600,000 to each grandkid by the time they're 20. And it was more of a generational transfer transaction for him. And he modeled a 20-year 20-year investment plan where he'd help each kid, and also that $2 million would get to, I think he mentioned about $8 million in 20 years. So he saw the benefit of that. Traditionally, this would never fly through a normal retail bank because of his age, because of his debt, and they wouldn't be able to allow for increased SMSF drawings tax-free. through a private bank that we know quite well, through access to credit, we were able to help him approve that loan. We presented this strategy with his wealth manager present. Everyone was on the same page. And then ultimately we have happy client for life. We've got their 4 children, which will end up being clients for the wealth advisor for us, hopefully, and then also the 10 grandchildren. So we are in it for the long term. So, we see this from quite a time and time again for these clients, and we sort of funnel it down to the generation. So look, that's me. I did talk quite a lot on that. Does anyone have, I guess, any questions on what I touched on? Any thoughts?
I've got one for you. We know for a fact we're in the midst of the largest intergenerational transfer of wealth from the older generations to quite potently the newer generations, so children, etc. One of the things we get amongst our existing clients is they're aging. Can we pledge for our young children, for our grandchildren? How does that sit with you as a sort of lending solution provider? We're not a lender, but are you finding that that's quite relevant?
Very relevant. Yeah, absolutely. We do have a lot of what they call family pledges or family guarantees. Before I came here, I actually met with a high net worth client. I wanted to help 2 of his kids get into property. Property in Sydney is very expensive. So what he wanted to do is he didn't want to just gift his child, 500,000-600,000 because he didn't want a sense of entitlement for his child. So what he wanted to do is put a amount of debt with the bank where the son can service, get him in the property market now, pledge his family home as well as security, which banks can do, and allow him to make repayments, make him accountable for those repayments. Didn't want to give him the silver spoon either, and that's one way for the child to get into the property market, especially in Sydney. We have seen that more and more often. We probably see it weekly now, whereas maybe 12 months ago we saw it once every few months.
Quite relevant.
100%.
Topical. Any other questions, guys, that you may want to ask?
In respect of those pledges, are they also good as a protection of an asset moving forward in the event of a marriage breakdown? Or
they can be, yes, 100%. And also if they're worried that they will get into a relationship where they're not fond of the other party. I've heard that before. So the family pledge, so let's say you want to pledge your home as say 20% equity of your home as co-equity for the purchase. That is protected on your side. It's, let's say the family breakdown with your son, for example, and his spouse. That only applies to the property they're buying. It doesn't affect your property. So it's as a protection as well.
Oh, terrific. Thanks, Al.
Thank you.
I hope you can hang around for another 10 minutes, 20 minutes.
Of course, 100%.
As I pass over to Michelle. And I guess we've talked a lot about wealth creation by way of looking at it from macro, micro theme, lending opportunities to create wealth, unlock wealth, to build for yourself as a client and obviously younger clients. But it'd be amiss of me as an advisor that looks at client situation from a holistic perspective, not to talk about distribution by means of estate plan, having a good will or having a will versus not having one. Michelle Johnson comes with plenty of experience about her personal experience. We just shared with you this morning about that you were involved in a case where there was multiple accidents, losses, implications of that. Implications on not having a will in New South Wales, how the formula of determining who owns what, and I've seen that at work. It can be predatory. It can be, most concerning, but that is the law with which we exist. So passing over to you, there's no presentation slide. Everyone can see and hear you loud and clear. And over to you, sharing your experience. And
I don't have the statistics and graphs. The only statistic I can offer you is that people usually die about 12 years after making a will.
Yes.
And so I always tell them to come in and make a new one every 7 years, 8 years, give them an extension. So I'm sorry, that's the only statistic I'm looking for. Look, thanks for inviting me to participate today. It's warming to me to hear someone talk about relationships in their practice rather than transactional work. In this area of practice, particularly in will making, will is just part of a succession plan. And it's so important that we all interact between each other. I don't believe that a person can draft a will effectively, and I'm talking about high net worth in particular, in isolation. You really need to draft a will in such a way that you pass it through or involved with, your planner and your accountant, perhaps super, whatever. Because if you do things in isolation, they usually don't work. We've got to confess that we don't know everything, and we are far better to get a team involved in structuring a succession plan than just try and do it alone. So I welcome your thoughts on that today. It's just reassuring because so many people, think that it's an opportunity to do a one-off and put it away. It's not. And once you have a will, I stress the importance of reviewing it. And as circumstances change, it's so important to reflect on that. And I shared an example with you this morning of a will being structured perfect prior to a remarriage, a blended family, and then a planner changing some assets without reference to the will drafter, and of course the whole plan imploded and involved litigation. So a good will should look at not only the financials and investments, but we need to look also at the emotionals. And at a time of grief, the best thing that you can offer someone is financial security. So what we should be looking at is putting in place something that's sensitive to needs. And the best way you can do that is have a relationship with your client. Because if you have a relationship with your client, they feel confident to tell you about the skeletons in the closet. And it's sometimes those skeletons that can make the difference down the track. So I think this is an area of practice where relationships are very important. So then why have a will? Well, if you don't, there's a formula for how your estate will be distributed. That formula is set in concrete, subject to what might be family provision legislation if there's not sufficient assets left for someone within a defined formula set by the state. But it's more cost effective also and more timely to have a will. If someone dies, you can readily go to the court, get probate and start dealing with the assets. In some cases, and I highlight, just for everyone's information, everyone says, well, it's a 3-month delay. In cases where there is genuine need or genuine need to adjust assets or deal with assets, you can apply to the court for either a expedited grant of probate or alternatively for its permission to deal with one particular asset. So, for example, last year I had a client die and we had to complete a sale of a property, and the contracts had been entered into prior to death. So we had to ask the court, if they'd expedite the grant so we could complete the sale in accordance with the contract. Otherwise, it'd fall over within that 42 days. So moving on to wills and the types of things that one needs to consider. And I know I've been given 10 minutes, and that's very, it doesn't give me much scope, but I think they're important things to remember. One is your choice of executor. An executor needs to be someone primarily that you can trust. Someone you can trust to administer your estate, someone with the commitment, ability, and importantly, skill to administer the estate. And too often, people appoint someone who doesn't have all those qualities, and it impacts on the process, and particularly, during that grief period. If there are complex issues to be dealt with, maybe they need a support person with them through that process. Two executors, one holding the hand of the other, or maybe in some instances it's justified getting a trustee company. If you've got a blended family and it's not harmonious, it can be a very, very difficult time. So sometimes having an independent, impartial, objective person there, it's a good look. Other things that I think that we should be considering, and I alert for the purposes of this presentation, is how there are various options that we should consider for particular beneficiaries. We need to consider, yes, who we want assets to go to, but how are they most effective to that person? How is the gift most effective? And we look at exposure. If you have someone who is exposed to litigation or potential litigation, say an engineer, an accountant in a large law firm, you may not want to leave your assets to them. You might want to leave them to a trust or whatever. Again, this is becomes a team effort, because you might be dealing with the beneficiaries' advisors as well in structuring how the best way to convey the gift. Another option, and another criteria we should be looking at is someone who has a child with special needs. Some might use the expression disabled, but I'd prefer to use the word special needs. Someone who perhaps might have a child with a physical or mental disability, or perhaps just not able to deal with the financials, and putting the right structure in place to protect that child. There's also a beneficiary who might have a chemical dependency. I used this as a presentation in Queensland, could only happen in Queensland. And someone says from the back of the room, "Hey, love, what's someone with a chemical dependency?" Which I said, well, someone with an alcohol or drug problem. To which I hear the words, "Up here we just call them druggies and alcos." And I just shrunk. But it brought everyone to the table. Another thing that we can look at for a potential beneficiary is someone that might be a spendthrift, or or in an unhappy relationship, and how to structure things around them. So I think I've probably done my 10 minutes. But I've just tried to capture those important aspects. One is having a good relationship with your advisor and being able to be full, frank, and transparent with them. I've been involved with a case once where there was a same-sex relationship, and that hadn't been exposed or wasn't known in the family, and that created huge trauma, including ashes being deposited and the partner not knowing with them where they were. So that's what I mean about full and frank disclosure.
Yeah.
It really adds to the grief process. And if you want to increase the wealth of a client, the last thing you need is including the legal profession as a beneficiary of the estate. So it's so important to encourage clients to be open, transparent, and frank about their position, not only just financial, but the emotionals. And that can greatly enhance any succession plan. So I'll leave it to you there.
That's terrific. There's so many questions I know I want to ask, but there's a few that may want to ask questions. We've got Joe as well, who's a solicitor out at Maroubra Matraville Way. But one of the questions, one of the things we were talking about is clients, when we talk about skeletons in the closet, is potentially they have overseas assets, and thinking having an Australian family will covers those assets, or vice versa. There's that conception that that's the case if they have a will at all. But your views about that? It's important to make sure we know about those assets.
Well, yes, it is. And I mean, it's becoming increasingly difficult to covertly exclude overseas assets, which I know that there's been that huge purge with American citizens. But it's advantageous, again, to look at whether you have multiple wills, one in each jurisdiction. I favour that process. A lot of people don't, but I favour that process with one caveat, and that is that if you have multiple wills, you've got to make sure that the last will drafts person doesn't say, use paragraph 1, I revoke all former wills. Right? Because that can revoke, right? So that's the one caveat that you put on your file. I have a client with 3 wills, and each time they try to change one of those wills, make sure that that clause doesn't appear.
Very good point. Yes.
So as I said, I would favour multiple wills. The reason is that then you can find things and you prepare a will that's complies with a particular jurisdiction. Now, I have had cases where, and this could only happen between Queensland and New South Wales, but when New South Wales introduced the informal will in 85, and Queensland didn't have such a process, there was litigation over whether an informal will could be administered in Queensland, and after spending 30 grand on that particular process, they then came back to New South Wales, and as it dealt with New South Wales assets, we could have avoided all that. So I'm using a Queensland, New South Wales example, but you know, US, they have different laws, they have inheritance, taxes, all of those things. They're things that you've got to investigate. So I would suggest that the prudent lawyer who has clients with in multiple jurisdictions or global assets should look at working with a local lawyer on the ground with comparable skill set and put the 2 wills in place.
Yeah, that's terrific. I don't know if you've got another question. I've got another question. The classical case where you've got a busy working household where either partners have no time, or they consciously don't want to talk about making a will, and they find copious amount of excuses between reviews why they didn't have one done. And they go, what about the will kit from the newsagent? Will that do? And my answer is always no, because you're not really looking at the total situation, like what you mentioned, proper executor, attorney. What are your views about that? You know, proper drafted will by a professional like yourself, Joe's online, versus just grabbing a will kit. It's online now as well. You can just draft it. And the classical error they make is the beneficiary sign it. And clearly they cannot, right? And so what are your thoughts about that? Are there...
Well, you're talking about impartial, objective response to you, because as a lawyer, I would say send everyone out to get a will kit, because it just enhances the costs.
Yeah.
You know, on a
Sure.
serious
I
note,
get you. Yes.
I would not recommend anyone with high net worth to draft their own will. In all sincere response, it really is irresponsible. And you know, you've got to. There's also things like guardianship that people forget in those wills. And if you've got little ones, you've got to look about who do you want to appoint as their guardians? Who do you want to look after their financial needs? All of those things. And I don't know that those points are significantly captured in the will kits. Look, it's an option of last resort. If someone is seriously ill and in a hospital and you can't get a lawyer out at 2:00 in the morning, now, I've been called out at 2:00 in the morning, but if you can't get someone that's foolish enough to leave their mobile phone on in emergencies, then the will kit is the answer.
Yeah.
But that is, the only case in which I would recommend, a will kit. And even, there are now provisions in our legislation which enable us to, in emergencies, write, these are what my testamentary wishes are. In the event that I die in this operation, this is what I want, sign it. The formalities can all be overlooked, and that document can be admitted to probate if the court is satisfied that it represents someone's intention.
Yeah.
So in short, my answer is I don't recommend will kits except as an option of last resort.
Sure. And as a connection to that, the notion of property ownership, and naturally people think in a couple or interdependent relationship situation, joint assets go to the survivor, but then there are other assets that are not captured under the will that they think automatically goes to them, or e.g. where they've borrowed money for a home loan, it's in the name of the spouse that passes away, and it becomes an absolute horrid story. We've got one evident in our client set. What are your views about understanding ownership structures, which is an estate asset, which ones are not, because trusts, for example, are not?
Well, it's one of the greatest reasons why you sit down and have a good relationship with your client and go through these things, because clients will often think, well, I own this, I own that. Yes, they may control it, but they don't own it. So yes, it's a really good point. And I have been involved in litigation when, thank God I wasn't the will drafts person, but there were assets owned by a company, assets owned in partnership, and assets owned as tenants in common. And they were all referred to as my assets. It ended up in 10 years of litigation and lots of dollars. So it's so important that you differentiate what assets you own, manage, and control.
Especially when we talk about lending and who owns what, where the lending is, it's very important to clarify. On that note, Michelle, Sal, fantastic. Any more questions, guys, before we wrap up? We've reached the hour and a bit. Hopefully that's been
a bit.
No, that was fantastic, and as it was for Sal and the Australian Super crew were fantastic. Just to wrap up our webinar, just want to say thank you to our lovely panel for attending. sharing their wealth of knowledge, Australian Super crew, the attendees, combination of clients, referral partners. We will have a recorded version that will be sent out to our clients. And of course, feel free to reach out to Salvador. I'll have his contact number for any lending solutions, and I'll have Michelle Johnson's contact. Absolutely comes highly recommended from all corners. So without further ado, this wraps up our 2025 webinar. Thank you. Bye, guys. See you.